Welcome back to another episode of Palisade Radio. I'm your host, Karem Mamutlu, and on today's show we welcome David Wilson, who is an analyst and strategist with over 20 years' experience within the commodity markets. Welcome to the show, David.
Thank you, Karem.
As I mentioned in my intro, you've had over 20 years of experience within the commodity space. So it'd be interesting to go over the early days of the commodity industry. I know you've been an economist, an analyst and strategist, but say 20 years ago, what was the commodities complex like back then, and which markets were you covering and why?
Well, back 20 years ago, I was really starting off my career with CRU, who are obviously well known in the metal space, and they're commonly called the Commodity Research University because so many people who have gone on to other roles, whether in the metals mining space or banking, have been through that research house. I started really looking at aluminium 20 years ago, and I managed CRU's aluminium cost studies and a lot of the market analysis and writing monthly reports and quarterlies and so forth. And back then, really looking at what moved metals markets, it was far easier to understand than the situation we have now. I mean, I think you could probably argue that 20 years ago, metals markets were not financialized, if that makes sense. There wasn't really that much in the way of fund activity. Obviously, we didn't have algorithmic funds trading on various market indicators. It was all very much more simple, that you could understand what was going to drive a metals price by looking at its basically its supply and demand fundamentals, and a little bit of macro view on exchange rate movements and so forth. You didn't really have to look at fund flow or the changing nature of fund activity within the commodity space at all. So it was significantly simpler than it is today. I mean, obviously today you have to look at so many more variables to try and get an idea of what's driving price and where prices are going to go.
The last 5 to 6 years within the precious metal space has been pretty ugly, not just for the price of the commodities themselves, but for the lack of capital in the industry as a whole. So has this been the worst bear cycle that you've seen within your career? And from your contacts within the industry, are things starting to look brighter due to the price movements we've had in gold and silver this year?
I think you can go back to the 1990s and look at that for also a period of relatively weak pricing and a lack of capex flow. I mean, financial flow into the mining space, and then a lack of capex expenditure in supply side, mine side development, and things really started to take off in the 2000s. Largely with the takeoff of China as a metals consumer and a product fabricator, and also growing investment markets within China, and the appetite for gold as a main investment vehicle. And so if we compare the 90s to now, it looks fairly similar. That we've had a real fall off in capex spend by the mining community really since 2012, and that's obviously had a degree of impact on supply side issues for precious metals, and obviously for base metals as well. Right now, if we look at pricing, obviously gold prices have taken off pretty well since the middle of the year. I mean, as an analyst, looking at the gold market in particular, all the constituent parts are in place for a gold rally really since the beginning of the year. So it's a little bit of a surprise that it took 4 or 5 months of the year before gold prices really began to take off. But I don't think everything goes in cycles, and as I say, I think the current cycle was really a repeat of what we saw back in the 90s, when there was general disinterest in the commodity space. So we're we're looking at, as I say, 20 years later, and we're in a similar situation. Obviously now, when gold is picked up significantly since the middle of the year. We've had obviously a number of rate cuts in the US. There's an expectation of further easing in Europe, and perhaps even a pickup in fiscal spending in Germany to try and boost the wider Eurozone economy. We've seen easing in other parts of Asia, whether you're looking at Japan and Korea and so forth. So when you sort of get into these easing cycles, obviously gold becomes an attractive place as an asset, portfolio diversifier, and we saw that in the immediately post the global financial crisis in 2008 and early 2009, where you start to see significant money printing from all the major global central banks, and that saw a significant gold rally up until about 2013-14. So we've seen these easing cycles before, and we've seen gold benefit from that. And as it has done this year, and it's repeating that sort of easing cycle correlation as we saw from the global financial crisis.
I understand for the last couple of years, David, your recent focus has been on the copper market. So it'd be interesting to talk about that. And what are your views on copper, say, over the next couple of years?
Yes, I mean, the copper price has been quite interesting, particularly this year, where we've seen generally the fundamental market look really quite supportive. We've seen lots of mine supply outages. We've seen that the treatment charges paid to copper smelters collapse. That indicates a or a tightening concentrate market because of the lack of mine supply. And copper demand, although not stellar, has been relatively good so far this year in China. A little slower than last year, but the reason really why copper's struggled is more from the investor sentiment point of view. Copper is perhaps the most macro played of the base metals, and obviously we've seen slowing Chinese growth, whether you look at IP or GDP. There are fears that the US economy is beginning to show some signs of slowing, and obviously the trade-related disruption between the US and China has occurred really since the middle of last year hasn't helped, and copper's obviously become depressed. We've seen a significant exiting of investor interest from playing the copper markets, and you can look at whether it's open interest on, for example, the LME or the Shanghai Exchange, or daily contract turnover has shrunk quite dramatically over the last year. Does this have a bearing on how copper looks going forward? Well, we thought we were beginning to see a pickup in capex spend in the mining space in copper this last year. As I mentioned before in the previous question, we'd generally seen quite a significant downturn in capex spend in the mining space since 2012. As I say, we thought that we were going to begin to see that pick up over the last year. It really hasn't, which is then sort of, you could argue, setting in store continued tightness within the physical copper market. So if we look forward into next year, what can we expect? I suspect we'll see treatment charges compress further. The term levels this year were around about $80 per tonne for concentrate. I suspect they're going to be quite a bit lower than that next year. That brings then problems to all major smelters, and particularly China. As TC is depressed, that means the smelters are getting paid less, and it sort of brings the economics of smelting into question. And then we have a look on the demand side. As I mentioned, it hasn't been stellar this year, but reasonably okay. There's been so much talk on the electric vehicle and alternative energy impacts on other metals such as nickel and cobalt and so forth, and that was a big focus of discussions during LME week. But copper is also going to be a major beneficiary of the, let's say, the electrification of transport systems, whether it's cars or buses and so forth, the build-out of more and more electrified rail networks, as you're seeing in China, but also the longer term, the effect of disaggregation of energy generation as more and more office buildings and homes become effectively self-contained generation units with through the use of solar, and that will require significant volumes of copper and other metals, because you will need energy storage systems in building basements and so forth. The demand side, longer term, looks very, very positive as we switch from, let's say, a carbon fuel-based global economy, a powered global economy, to alternative sources of energy. The timescale of how this plays out, you're really looking at for EVs probably 5 to 10 years forward, and for electricity generation perhaps longer than that, 10 to 20 years plus. But we are going to see continued strong demand for copper going forward. That means we are going to need to see the supply side, the miners, begin to spend more on copper projects, and typically copper projects will take at least 8 years plus between discovery and development to come to market. So there's the potential for, going forward, continued, let's say, supply side gaps, which then means from a pricing point of view, copper prices should perform relatively positively over the longer term.
Excellent. Well, let's go through a few books that have helped you within your career, David. And are there any commodity-specific books that listeners should pay attention to?
I was obviously lucky to start my career at CRU, where there's a long history. The company started in the late 60s, so there was an awful lot of already written material that the company itself had produced over the decades. I think I've learned more from people I've worked with rather than reading specific books. I was very lucky to work with David Humphreys, who had been chief economist at Rio Tinto, and then we worked together in the Norilsk. And he'd got a very long history of original thought in the metals and mining space while he was at Rio and before, and he has published a large number of books, which I'm sure listeners can find on Amazon or somewhere. I was also lucky enough to work with on the banking side with some very smart people. A standout for me was Alan Heap, who had been at Citigroup, and he was the first person to coin the phrase the super cycle, or commodity super cycle, with reference to the China demand growth story that we saw sort of kicking off in the early 2000s. So it's more, I've learned more from people I've worked with rather than specific books I've read. They're also, when I was through my career in CRU, there were a lot of very, very good bank sell-side research analysts that I read avidly. Some are still working, like Jim Lennon, who's still at Macquarie Bank. Others have retired now. Malcolm Southwood, who was at Goldman Sachs many years ago. So it's more me reading good quality bank research, and obviously a lot of the material that CRU had written over the years.
Okay, as we begin to wrap up, David, is there anything else you would like to share with our listeners today? I know palladium has been very strong this year. Perhaps you can give us some comments on that.
Yeah, palladium's been one of the outperformers of the year to date, and obviously there are some deeper issues at work here. If you look back at last year and the year before, and the fallout from the sort of diesel scandal through Europe, you've seen a lot of auto manufacturers switching to let's say more gasoline-heavy fleet offerings. We've also seen a number of upgrades to emissions regulations, and obviously we have more coming next year, which have meant that auto companies have had to increase the palladium loadings in auto catalysts. And this is not just a Western world phenomenon. Obviously, we've seen China significantly upgrade emissions controls within their sort of auto fleets, and this is really seen quite a significant drive in palladium demand, and I think you could argue that China has been a very, very big factor in that. And then on the sell side, on the mining side, we haven't really seen much in the way of supply growth. And, South Africa is around about 40% of supply, and then Norilsk in Russia is another 40%, and the rest really in North America. And we haven't really seen any supply growth from any of the major producers. And obviously, if you just look at the basic supply-demand fundamentals, the market's got very tight, and there's a lot of the sort of analysts are suggesting that we're in the sort of third or fourth, or maybe even fifth year in a row of significant palladium deficit, which has meant that above-ground stocks have or known above-ground stocks have got very tight. There had been an expectation that with this the significant ramping of palladium prices and palladium significantly overtaking platinum prices, for instance, we begin to see the auto sector substitute between palladium and platinum, or also into more rhodium as well. This doesn't really seem to have happened, and I think the key issue there is that a lot of the auto companies are looking further forward in terms of what the motive power for their sort of offerings in the future is going to be. And obviously, most of the big car companies are putting an awful lot of capital and effort into developing EV fleets, and so the cost of having to re-engineer auto catalysts and recertify auto catalysts to have more platinum, to substitute in the relatively cheaper metal, hasn't happened simply because the cost of recertification is fairly high, and also companies are spending most of their investment money on developing EV fleets. So from my point of view, it looks like for the time being the palladium market is going to remain very tight, and I think we're going to see continued upside in prices.
Very good. Okay, many thanks for your time today, David. Much appreciated. And I'm sure we'll have you back on the show next year.
Thank you very much. It's a pleasure.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?